Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we welcome Rex Salisbury, founder and managing partner of Cambrian Ventures, to discuss building a community-driven venture fund. Rex shares his journey starting off in investment banking at Merrill Lynch after the 2008 global financial crisis, and why he decided to take an online programming course and move across the country in 2015. Rex explains how he initially started Cambrian as a product meetup in 2015 as a community of members and founders interested in the FinTech space, and how that eventually landed him a role at A16Z as a partner on the FinTech team, where he backed unicorns like Deal and Tally. We jump into how Rex decided to launch his first solo GP fund with $20 million in capital to back founders focused on the FinTech space under his community-given name Cambrian Ventures, and why he thinks now is the best time to build in the FinTech space. Finally, we push Rex to share his views on the current FinTech landscape and how some businesses will not survive in the current interest rate environment. Now let's jump into the tank for this week's episode with Rex Salisbury from Cambrian Ventures. Thanks for joining us in the tank today, Rex.
Hey, it's awesome to be here. Thanks for having me, Matt.
You know, Rex, your journey starting off in the investment banking world at Merrill Lynch in 2008 after the global financial crisis just seems like a great place to kick things off on your background in finance. And maybe if you can give us a brief history lesson on how you got started in the finance world and then eventually how you made your way into the startups and eventually the FinTech investing space.
Yeah, you bet. Like many folks, I ended up in investment banking, and surprise, I did not like it very much. So I learned a whole lot, really value my experience there. I actually did a whole bunch of different things when I was at the bank. I did real estate syndicated finance, really big debt facilities for publicly traded real estate companies. I also worked on reporting around our global traded portfolio, so saw some of the risk controls that very large banks run internally. And then I also even worked briefly on the workout group for distressed SMB lending. So I saw all sorts of different things across global trading, small business credit, to like big real estate debt transactions. And what was shocking to me was just like how broken every single one of these things, like, or components of every single one of these things was. And also, as like a young person with a new career, how deeply unhappy a lot of my more senior colleagues seemed to be. So I was like, A, like, the work is kind of boring. You learn a lot, but it's kind of boring. B, like, people aren't very happy with their jobs. And C, like, a lot of the way in which business is being done seems kind of broken. And like, there's a lot of potential for automation. Maybe 3 anecdotes you can edit out and, pick any of these that you think might be interesting. One is I had a colleague who helped manage the balance sheet for Bank of America, $2 trillion asset bank. How do they do it? Well, they would like dump it out of a bunch of data systems and then into Excel. But at that point, they were running like a 03 version of Excel or something like that didn't have that many rows. So they would actually dump it into a bunch of Excel sheets and then do like a giant map reduce just to figure it out. And you're like, wait, this is like how you know what your risks are, is you're doing map reduce with Excel? That's insane. Then like for the SMB banking one, this was a distressed portfolio. So I was sitting over as like a $500 million book of loans for small businesses in the Southeast. And what's crazy to me is like, how do you do underwriting? You have a 10-point scorecard and you basically manually spread the tax returns of the business. The biggest input is the debt coverage ratio, which makes sense. The other biggest input is the owner's FICO score. And a lot of times these are not guaranteed loans. It's just used as an indication of like credit worthiness and like general, because small businesses are closely held. So, having a good credit score. But basically like very unsophisticated lending modeling. And you're like, this 10-point scorecard, you're going to treat all these different kind of businesses as though they're kind of similar. Like, that seems very like a bad idea, right? And it turns out it was. Like, there were a lot of losses in that portfolio, and SMB lending is an incredibly problematic space for big banks to try and get involved in, despite the fact it's this huge part of the economy. I've actually done some investing in people who are helping automate and improve SMB underwriting out of this portfolio. And then the third one, real estate investment banking, really large debt transactions. Takes us 3 months to close basically the same credit facility with 2 terms that have changed in the 200-page credit agreement. And it takes like 20 bankers, 20 plus lawyers, 3 months to do this. And why? It's like, because everyone gets paid by the inefficiency. So they're actually very happy with the current state of affairs and don't really care to change anything. So anyways, I'm structuring these big debt facilities, sometimes $1 billion, $2 billion facilities. And I'm looking across the coast to Silicon Valley, where you're seeing technology and automation start to change how finance is being done. And you're like, look, low value, high volume loans and transactions within financial services are going to be the first part of the ecosystem that starts to change and starts to see technological adaptation. I'm sitting up here doing these very big loans with a bunch of people who are kind of unhappy. This is going to be the last part of the ecosystem that changes, but it is going to change. And I don't want to sit here for 10 years waiting for like the wave of technological innovation to catch up to me when I'm like unhappy and later in my career and then be like, well, now what am I going to do, right? Why did I learn to code? I was working at an investment bank, learning a lot, but not liking my work, seeing the way technology was starting to change things and being like, look, this is way more interesting. And so while I was an investment banking analyst, my actually very first coding course was an introduction to artificial intelligence taught by two Stanford professors, specifically Peter Norwig and Sebastian Thrun. That course, Introduction to Artificial Intelligence, later became Udacity, right? And so the kind of on, and then from there, I went into more just like regular coding stuff because that was actually kind of a hybrid course. So I was doing that on nights and weekends and found it way more engaging than my day job, found what was going on in the Bay Area way more exciting than what was going on inside the bank. And so it took me too long, but eventually I quit my job, drove cross country, and then joined one of the co-founders of SoFi on the engineering team to help build out and automate mortgages. Learned a whole lot, incredibly rewarding to actually build things that help people and like automate financial services. The company didn't work out, but it was an incredibly rewarding experience. And I'm also the kind of person who just like reflexively builds networks, relationships, and communities. And so when I moved to the Bay Area, when I started working as a software engineer, when I started building interesting products in FinTech, I was like, hey, I want to talk to other people who are doing interesting work in FinTech and building cool things. And so this was like 7 years ago when I was working at the company, which is called Sindeo. I was like, I want to start bringing together other people, founders, engineers, product managers to talk about things they've built in FinTech. This is a point in time where the FinTech ecosystem was just kind of getting to the scale where you could start aggregating and bringing together interesting folks. And so that was kind of the birth of Cambrian, the community. I now run Cambrian, the venture fund. So Cambrian, the community was interesting people in the Bay Area coming together to talk about something they built. Our very first event was in some like co-share space in downtown. I like bought a bunch of pizzas, had my team present on the fully automated online mortgage pre-approval we had built. The Plaid team demoed their Plaid API, and then a third team demoed an app that they built where Plaid was one of the primary kind of infrastructure providers for what they're doing. And then from there, Cambrian, the community just grew because FinTech was growing, and a lot of the most interesting and exciting things happening in FinTech were happening out here in the Bay Area. So we got to the point where Cambrian, the community, had 15,000 newsletter subscribers, 5,000 meetup members. Today, I also run a Slack community for 1,500 plus early stage FinTech founders. And then Cambrian was mostly about in-person events. So we're running in-person events in San Francisco and in New York, doing 2 annual summits. And then over time, as it grew, I got pulled into investing and advising for FinTech companies. And that is kind of what sent me on the path down venture of like, oh, actually, this is a great way of doing the work I love, which is interacting with interesting people, finding out what they're building, is to be able to actually like invest and support them. And so I quit my day job, was going full-time on Cambrian, the community, with the plan to raise a small venture fund. When A16Z reached out to me, because they had gotten to know me through like all the work I'd done in the FinTech ecosystem in the Bay Area, they're like, hey, we're starting a FinTech venture practice. So A16Z is kind of crazy because they're going to end the year, which the year is almost over now. Happy New Year, everyone. They're going to end the year at like 500 plus employees. When I joined, they were about 100 employees. And FinTech, they'd done a lot of FinTech investing, but FinTech was not its own dedicated sub-vertical. And so I was brought on as they were starting to build out that sub-vertical. I was basically the first partner hired externally. That made it kind of a team of 3-ish. And now they're 10 plus folks on the investing side of things, plus a whole bunch of operating partners. So A16Z, most of the headcount is actually not investing professionals, it's operating partners. And so verticalizing some of the operating partners as well to better support our portfolio companies and their kind of needs in the ecosystem across talent, market dev, corp dev, et cetera. So I ended up joining there instead of doing my fund because it's like, this is a great team, a great opportunity. But the understanding was kind of after 2 years, if I was still excited to go back to my roots, I could do that. And so I spun out early this year to launch Cambrian Ventures, the fund in January of 2022, focused exclusively on early stage investing in FinTech. And I basically do almost entirely US B2B FinTech, although I do look at consumer and some international stuff periodically. So that's kind of a little bit of my rough story. And I guess the the final thing to talk about there is like the kind of community aspects of my kind of previous life pervade now what I do as a venture capitalist. So Cambrian, the fund, takes a community-oriented approach. I still do a lot of the community efforts. One of the main community apparatus right now is that Slack community, which has 1,500 plus FinTech founders. But then for the fund itself, it has a community orientation to it, and they have 20 plus of the top founders in FinTech as LPs in the fund, including founders from SoFi, Betterment, Blend, Plaid, et cetera. And I'm constantly facilitating a lot of connectivity between portfolio companies, portfolio founders, and just other folks within the Cambrian ecosystem and network. So anyways, you asked me about investment banking, and instead I just kind of told you an entire story about how I ended up to where I am. But hopefully that's good context for you and your listeners. So
it's awesome. No, I mean, there's so many similarities in terms of your journey from like traditional banking into sort of technology investing and building communities that I went through on a little bit of a different trajectory. You know, when I spent my time in banking and working at RBC, I saw the same things that you saw that was just mind-boggling, like the amount of paper that was still involved in the systems, the amount of, slippage that you would see because someone sent a trade to the wrong account off by one digit and it wouldn't be tracked for like 30 days. And you can imagine like just $1 million plus position was just sitting somewhere. How could nobody catch that?
Yeah, the whole fat finger error genre of like financial journalism where someone fat fingers a trade and then doesn't realize it for like another 30 or 90 days or something is crazy. So
yeah, and I saw that firsthand a lot of the times. And when I eventually left, the space and was asked on my, way out, sort of like if I had anything I would like wish I could have changed. And I said to my boss, I said, I wish I would have known how quickly technology was going to disrupt this business. So I would have left the industry 5 years earlier because it was happening, like you said, like a wave, and you didn't want to be on that sinking ship and be the last one to jump overboard before everyone else did.
And just be unhappy, right? Like I feel like I know a lot of people are unhappy. There are other people who do love it, right? But there's maybe a bit of career advice that I think is kind of funny and interesting. The authors of Freakonomics, Stephen Levitt and his co-conspirator, they did a study where they basically got a whole bunch of people to pre-commit to making a major life decision depending on how a coin flipped. So people were already on the fence about this decision. And then they studied whether they're happier or more upset depending on the kind of life decision it was and what it. So the TLDR is there are a whole bunch of decisions they tracked. One of them was, should you quit your job? And for the people who flipped the coin and it said, yes, they should, they were much happier than the people who flipped the coin and said, no, you shouldn't. And so the takeaway was essentially, if you are thinking about quitting a job, the odds suggest, or the data suggests that you will in fact be happier after you do it. I hesitate to share this because a little more like the same was also true of relationships too, that people tend to stick in those too long. So that's a little bit less germane to this conversation. But to talk my own book, I guess, as someone who's helping a lot of companies hire, if you're thinking about joining an early stage company in particular, you probably should, because the data suggests it's a great idea, at least from a life satisfaction standpoint.
Yeah, I mean, you just need someone else to make the decision for you, basically, is the TLDR. Flip a coin instead of having to come up with a decision yourself, right? But, Rex, you've done so many things after you left the banking world that you alluded to, like building this FinTech ecosystem with Cambrian. You had these first meetups, which were designed as like product meetups with the Plaid founders and some of the people building on top of Plaid. And we're able to kind of leverage that into a newsletter with 15,000 subscribers and 5,000 meetup members and the Slack community that's still ongoing today before launching the fund. But the one thing I want to kind of double click on for a second is you decided to move across the country after leaving the banking world, learned how to code, which you don't see many ex-bankers willing to do, and pushed yourself into a life that was very new to you. I want to know, like, one, who was it that inspired you to want to do that? Was it just yourself? Or what was it that inspired you to push yourself to do those types of things when nobody in your genre was really thinking about doing that? And then the other part was, how the hell did you get hired as an engineer without any real engineering background?
So first of all, like, people sometimes are like, oh, that's a surprising story. Like, how did you do that? And this is one of the things I love about the Bay Area is, to me, it's not a surprising story at all. Because like, not everyone, but so many people I know literally did the same thing, right? They were people who had jobs they didn't like, taught themselves to code, moved here, found interesting work. People who wanted to start companies, knew this was the place to do it, had no business or no pedigree that should suggest they should be the type of person who would start a company. They were just hungry. They wanted to do it. They moved here and they did it. So like, yes, those stories are kind of exceptional, but that's what I love about the Bay Area is that those exceptional stories are relatively commonplace. And then in terms of like learning to code, who do I give credit to? I mean, really the people I give the most credit to are Peter Norwig and Sebastian Thrun, who offered the first massive open online course through what later became Udacity. They were then computer comp sci professors at Stanford. And their first course, Introduction to Artificial Intelligence, required pseudocoding and algorithmic thinking, but not actually writing code. And it was done remotely. So here I was on the East Coast, able to take a course from top computer science professors in the world about artificial intelligence and be like, wow, this is way more interesting than anything else I studied in undergrad. And that gave me the conviction that like, oh, if I learn engineering, I will also get to be able to do really interesting work. So it was like a great way of basically bridging both geography, but then also like the types of materials and learning that I had to do. And by the way, like I feel like whenever someone tells their career story, it always seems so linear in retrospect. But it's like there are a lot of other things I tried along the way. Like I tried starting several different kinds of companies back in Charlotte, which I was actually working out of Charlotte. So Merrill is a New York firm acquired by Bank of America. Bank of America headquarters in Charlotte. Still is, I think, the second biggest banking center in the country. It certainly was at the time. Some stuff has shifted around in the decade plus since I've left banking. And so I was there and like, I took too long to leave. This is another thing I've learned is that like networks and ecosystems really, really matter. And they really matter in the earliest years of your career. I think this whole like remote working thing is really, really bad for a certain cohort of people. And that is people who are just starting their careers because you used to have this one unfair thing you could do as a young person. Not all young people, but some young people were able to physically relocate into network dense areas and then physically be present and learn through kind of osmosis and interactions and social networking, et cetera, how an ecosystem operated, how like the day job they were doing actually worked. If you are now like an investment banking analyst working 12 whatever plus hour days from like your parents' basement, you get none of that. And the work is still as miserable as it ever has been. And that is hugely detrimental. Now, if you're later on, you already have those networks, you already have that accessibility, you kind of know who to call and how to like, navigate through ecosystems, not as material. But for people who are early in their careers, I still think one of the most important things you can do is relocate to a network-rich area. And usually for technology, that's the Bay Area, right? People like to pretend that like everything's in the cloud, but especially if you're early on in your career, the reality is and even if you're later, frankly, I think people understate the extent to which it still matters, even at the later stages. It's incredibly important to be places like here. I think New York is also a great place to be. And I do support all kinds of companies who have, in-person presences, fully remote presences. But I've actually found that a lot of my portfolio likes to be in person at the earliest stages if they can. Not everyone, but that's the plurality, I would say.
Yeah, I mean, I think what I realized as a manager with a team underneath me is that I sort of took advantage of having the ability to build out a network during my time working on Wall Street and then building a tech company and then working for one in Boston, New York, and benefiting from all those, like you said, social engagements and networking that we took for granted. And I think that now that's been removed or partially removed because of hybrid work, there's part of that social contract that is being broken with the next generation of up and coming, students and entrepreneurs and builders who are missing out on that. And it's not really fair that we just took that away from them that we got to take for granted. And so we need to make it possible for them to at least experience that, which is a huge vital part of like exactly osmosis and mentorship and apprenticeship, especially in our industry, where it's a lot of it happens over a longer period of time and it can't happen in a quickly condensed 3-month like co-op program. But that we'll save for another podcast. You mentioned after you did some engineering work on the product side, you spent 2 years at A16Z, one of the best, venture funds in the world on the FinTech side, and were able to back some amazing companies like Deal and Tally. What was it like working inside one of the greatest venture funds for those 2 years? And how did it shape your understanding of the actual venture capital industry at large?
I had a great experience, loved my colleagues, loved the firm, got to work with and back some great entrepreneurs. I'll add too on both Deal and Tally, how I originally met both of those founders was through the Cambrian community. So Jason, the CEO of Tally, he was a presenter at one of our annual summits in the Presidio. many months before we ended up leading the Series C. And then Deal, they were actually presenters as well at another monthly talk. I used to do once or twice a year a kind of YC FinTech showcase of both recent grads, also grads that are maybe a little bit farther along. And they were one of the presenters there, and they presented at that event a few months before we ended up leading the Series A. So that is to say, a lot of the work that I did as a venture capitalist inside of a fund was still related to the work I had already been doing through running Cambrian, the community. But the benefit was now I got to learn alongside a group of folks who had been doing investing for a long period of time. Alex Rampell, who founded TrialPay, Angela Strange, who was one of the first partners promoted internally at A16Z and is a very well-regarded fintech investor. And so the ability to work with really great people. And then we brought on some other great folks as well. And so the opportunity to work with all of them was a great learning experience, and also just to have the visibility you get from being at a firm that sees so much of what's going on. It's also just very interesting intellectually to be inside of a firm over the last few years during the venture bull market, because venture has gone from being this cottage industry. So 2012, about $12 billion in venture was deployed in the US. 2022, about $200 billion roughly was deployed in venture in the US. So you're talking about a 10x growth in terms of the ecosystem. By the way, actually kind of a funny substat to that is that venture debt is now as big as venture capital was a decade ago. So about 20 billion in venture debt was deployed in 2022. But what this means is going from being this cottage industry to this more institutionalized asset class. And that's going to precipitate a whole bunch of changes. I actually had a conversation with Frank Rotman, which I recorded and will be sharing later on my YouTube channel, about what he sees as kind of the new stable points of venture capital in the future. And in particular, we talk about a few antecedents of, professional services industries that were highly fragmented and then became kind of more concentrated with a few breakout leaders, but still had a long tail. So an example would be accounting, right? Like the big four in accounting. Those kind of started to grow and coalesce in the 80s, when before it was just a long tail. And we still have the long tail in accounting, but you also have the big four, right? Something similar has happened in consulting. I would also add something has happened both in kind of banking. Like banking used to be a whole bunch of, small banks. Then we had the interstate banking laws change, a lot of, mergers, consolidation. And now you have kind of the big five in the US. And so as venture institutionalizes in the US, we're probably going to see both the continued existence and importance of the long tail in terms of serving certain niches and specialization. So I fit into that in some sense, in that I am a solo GP focused exclusively on investing in fintech companies. But you're also going to see the growth of probably mega firms. And one of the firms that typifies this the best is A16Z, which, as I said, went from being about 100 folks when I joined to about 500 folks today, from sub 10 billion in assets under management to north of 50 billion in assets under management. And if you kind of follow this forward another 10 years, it's very interesting to see, like, maybe someone like A16Z is a multi-trillion-dollar asset manager that does all sorts of things in an ecosystem that is venture, but is so much bigger than it used to be that doesn't even quite accurately describe what it is. And you're starting to see this. Right when I had joined, A16Z launched their very first growth fund, which David George leads. They also then, right as I was leaving, launched their first seed fund, as well as their first incubator program. They also raised a record-sized crypto fund. In the last year, they announced that they actually also, right, I joined, transition from being a venture capital firm from the regulatory sense of the word to an RIA. And then this year, they also announced that they're going to launch a wealth management arm, primarily for the founders of companies and other folks within the A16Z network. But they're going to start to look more like a large asset manager where venture is the core competency, but eventually all groups that control large amounts of dollars start to bleed into the other aspects of what you do when you manage large pools of money, right? Like if you're a large insurer who manages a lot of assets, maybe you have a direct venture arm, right? Which is kind of bleeding over into what A16Z is doing. If you're a large hedge fund, you move into privates as the private market expands. So some of these venture firms like A16Z are going to become these kind of potentially these very large, interesting entities that kind of define a new category within the financial services ecosystem. And I think actually maybe one of the best historical antecedents would be if you look at the 80s, you saw the growth in asset management of four very different kinds of distinct firms, but there's something in the water and in the timing that made sense, where you had Vanguard, BlackRock, and Blackstone. Vanguard being passive asset management, BlackRock being various forms of asset management vehicles, but now they have a large passive component, and then Blackstone being a publicly traded private equity firm, right? And all of those started around the same time, have very different models, but have become very large and important players in the ecosystem. And stuff like that's going to happen in the next, we're in a little bit of a down cycle right now in venture, but like it's going to come back. The reality is starting companies is like an incredibly powerful way to drive change and create value. And that hasn't changed. In fact, there are more talented entrepreneurs out there than ever before. So if anything, it's going to accelerate.
Well, I think it's completely related to what you have been focusing on, which is really also community and network. I mean, go read Steve Schwartzman's book, What It Takes, and the way he started, Blackstone and how it was created from just a single fund, private equity focused fund, mid-stage private equity, which was his first failure, actually. His first ever investment was his first failure, and how he learned from that and then built all of these different types of businesses outside of it, which then obviously, led to so many other firms being created as well, like BlackRock. You see the institutionalization of any asset class when it gets to a certain scale, that it just naturally flows over, the cup flows over into all these different other sort of lower tier cups in terms of like, managing a hedge fund portfolio or managing a real estate portfolio or healthcare and so on and so forth. I'm sure the day will come where A16Z, I don't know if it's going to be next year or a couple of years out, when they go public and the GP becomes a public company for retail investors to invest inside of that. But I know that day will come soon now that they're an RIA. You're not going to comment on that, but I know that is sort of where things will end up going, because when you get to $100 billion and the fees are just so large, there's nothing else to do but needing to find some liquidity for the GPs who have stake in the business and the fee vehicles that come inside of it. So I totally understand that. I wanted to ask though, given, your ability to see from the inside how A16 was being built to scale, how are you thinking about leveraging your community and your network to be able to spin out Cambrian into a venture fund? And how were you able to land your first few LPs and eventually, I guess, your anchor LP, if you have one?
For me, the transition was relatively seamless in that I've been very active in this ecosystem in this capacity for a long time. And people understood me as someone who understood like the FinTech network and ecosystem, and as a FinTech investor. And so I just put those two things together. And my anchor LP was not actually an individual so much as a group of people. Rather than go out and get like one large LP to be the anchor, the kind of way I thought about an anchor was getting a bunch of the top founders to be my anchor LPs. So the way fundraising worked for me was essentially going out to a lot of founders, many of whom I'd known for a very long period of time, some of whom I got to know through the fundraising process as well, and having very quick conversations to say like, hey, I'm now leaving, now doing my own fund. I want to have a bunch of the best founders involved in it. I'd love for you to be part of that. If you think, I'll be a good steward of capital, a good steward of the FinTech ecosystem, and also just provide an interesting opportunity to interact with some of the most interesting next generation of FinTech founders. And so that was a lot of relatively quick conversations to put together a great group of people. And then from there, went out and talked to regular LPs who are saying like, I told you I'm incredibly networked. Here's this great group of people who's already enthusiastic and supporting, and then off to the races from there.
No, I love that. You did the opposite of what some other people might think, is like you go and get that big, heavy anchor or institutional fund to be your first check, and then wrangle together all like the angel family offices, high net worths. But you did the opposite. You found the strategic founders who are, wealthy LPs as well in their own right, and showed the power of the network and the fact that the network was real, and then found the other institutional family office investors to join, correct?
Yeah, and these are it's not just dollars too, right? Like these are also really valuable relationships, both in terms of driving value to the fund, but also just like people I know, respect, enjoy being able to call up and ask questions of, and vice versa. And so it's like, if I want to do this, I also just want to have these kinds of people along for the ride as well, because it'll make my, being in venture is kind of lonely. The thing that keeps it less lonely for me is having a great community of people that I can reach out to and work with all the time. And so in some ways, it's been surprising how little I feel like my day job has changed after leaving A16Z, because venture is a very external facing role. And so now I don't have any of like the internal administrative and like meetings and like all this kind of A16Z is 500 people. The reality is a lot of your time gets gobbled up by just like internal stuff, even way more so than when I was there. And now I like don't have that, but all the external stuff I was doing is still pretty similar. So.
Well, speaking of surprising, what else has been surprising from the benefit side of managing a community like Cambrian that you never thought you'd be able to see come to existence and now can't imagine living without?
Getting to do what I do is great. And I enjoy it more than I expect. One of the things I really enjoy, so at A16Z, great firm, usually almost always a lead investor and usually the sole lead. It's very hard to be collaborative in the ecosystem, right? Because at the end of the day, you're competitive with basically everyone. Now I'm a non-lead investor. So I usually write a $500K initial check. That allows me to be way more collaborative within the ecosystem, which does a bunch of things. It means that I can learn more about what's going on because I'm not adversarial with folks. It's not that when I was at A16Z, you're still the vast majority of individuals within the venture ecosystem I have found to be good actors because the bad actors take time, but eventually get weeded out, right? But when there are competitive dynamics at play, it does mean that you can't interact and kind of share certain kinds of information in certain ways. And so now that I'm outside and a non-lead investor, I can actually kind of learn and see and do more, which makes my job more interesting. It also makes me more competitive. I have invested in deals that A16Z missed because they were preempted by another tier one venture firm, right? Or I invested in a company and then that company was preempted and A16Z kind of didn't get the opportunity to see it. And so just from a like deal flow and access perspective, what I'm doing is in some ways better than it was being inside of a very large firm. And that's just the nature of the strategy that I run. And then what's also been really interesting is just to see all the ways in which, actually, here's the other thing I really enjoy. So saying A16Z probably would have done like 2 to 3 checks a year, 2 to 3 investments. You take board seats and you, as you should be, as a lead investor, multi-stage investor, you are incredibly committed to that company for 10 years through thick or thin. But the reality is, as a venture investor, that means after a few years of investing, you're on a bunch of boards and you're kind of out of the market almost before you began your career. And that's actually not a great way to begin a career and to build like a platform and a network of relations. So I am very involved. You can ask my founders. I'm very involved for the first, kind of 2 years generally. My pitch is I provide access to networks, right? A lot of the founders I back are actually repeat founders, have great networks. But the fintech ecosystem is more expansive than it's ever been before. So I can help turn over stones they may not have thought of, bring in relationships they may not have realized were even existed. And I can be incredibly helpful with fundraising, both in the round I invest in and the subsequent round or two. Once you get to kind of a Series B, you have a board, an executive team. You've, to some extent, should have figured out your go-to-market. And all of that value I provide around network connectivity, while still valuable, is no longer as valuable relative to everything else that you have going on. And so it's a great natural kind of progression for me to then, spend more of my time with the other earlier stage companies. But had I said at A16Z, you spend all of your time essentially with your first investments you made in the first years of your career. And so it's just it's a better way, I think, of building a career from a long-term perspective and just a more interesting way of seeing and understanding what's going on in the ecosystem, which in turn makes you more valuable to the companies you invest in because you're more active and aware versus being someone at a venture firm who, really can't see that many new companies, is basically just following what's going on with the 10 to 20 companies they're on the boards of. And so that's kind of one of the other things and reasons I'm very, very happy to be doing what I'm doing.
Yeah, it sounds like a lot of like the, red tape and bureaucracy that comes with a larger multi-stage firm with 500 employees has obviously been removed. And I agree. The same thing, at our fund, I tell our LPs, like, how could I make 12 investments a year and be on all the boards? Well, we're not on all the boards. My partner and I split it. But after like the Series A or so, we step back to board observers and eventually our time becomes less demanding because there's new investors who obviously take on a lot more of the active role that we play at the pre-seed seed stage. So it makes tons of sense. But obviously with the pros and the cons of leaving a firm like A16Z, that means there's a lot more work on your shoulders. And being that you just raised a $20 million fund, you've already made 5 investments, including companies like Keep Financial. There's a lot more deal flow to source through. So how are you managing the opportunities in your funnel as a solo GP these days without having the back office support of an A16Z?
Yep. So first of all, I do have a great team that's supporting me. And I have basically a COO, CFO group that's supporting me. I have media and comms. I have a back office. So I have a lot of people around me who are doing a lot of the work in terms of the back office, but even some of the front office oriented things. So I do have that support now. I control it entirely and can make sure that I'm actually getting as much leverage as possible. So I can focus on basically supporting the portfolio companies and working with the kind of most serious prospective investments. But sourcing for me comes through a lot of different ways, right? There's a lot of cold inbound. I also have the community I run and manage, which generates a lot of connectivity. And then I also have the 20 plus founders who are all LPs in the fund who send me companies they're interested in or have come across or former colleagues that they've worked with, or they themselves might be starting a company. Of those 20 founders, like 4 or 5 of them are kind of actively thinking about starting companies right now. So there's a whole lot of different ways in which I kind of stay on top of what's going on in the ecosystem.
Yeah, there's so much I feel like you're getting pulled on for opportunities to look at, just given the vast size of your network, that it must be amazing and also extremely exciting given that you have capital to deploy. And we're currently in a market that obviously is in an increasing demand for that capital. Let's focus on the fintech part, though, for a second. Everyone is focused on fintech these days, and it feels like every startup, including ones in our portfolio, are doing something regarding embedded fintech inside their platform. So, first off, how are you defining fintech now with your current fund, and what areas are you most excited about in the fintech space these days?
For me, and this is what you'll hear most venture folks say, the most important thing is the caliber of the team. And this is one of the things I'm most excited about for the fintech ecosystem. 10 years ago, how many repeat founders were there in fintech? And not only that, how many people were there working at fintech companies? The answer is very close to zero, because fintech had really only just gotten started as a category. Fast forward 10 years, there are now 30, 40, 50, 100,000, depending on what kind of list or definition you want to use, people working in fintech. And you drill down in that a little bit further, that means there's a really rich cohort of serial operators and repeat founders who now understand both finance and technology at a ground truth level. Before, those founders often understood one of those things. They came to finance and they kind of started doing some technology stuff, or they came from technology and they started doing things in finance. Now you have these people who have been at it for 7+ years and understand both of those things. And so what that leads me into is, a lot of the early stuff in fintech was more consumer oriented, because the problems you can see in finance as an outsider are problems you personally face. Student loans, mortgages, bank accounts, right? After you build a student loan originator, a mortgage broker, a neobank, you start to realize there's all these other broken things and how the infrastructure behind financial services operates. And there's all these intersections of how fintech starts to connect and finance starts to connect into other areas that are less obvious to outsiders. And so that's why I spend so much of my time on kind of B2B fintech, and then a lot of time at fintech at the intersection of other areas. So spend a lot of time at the intersection between fintech and healthcare, and I have 3 investments now kind of in that category. A lot of time between fintech and proptech and real estate. I've spent time as a real estate investment banker and understand a lot of the aspects of how commercial real estate functions. And it in itself is basically now an ecosystem as large or larger than fintech 7-8 years ago. And then there's a whole other category of just kind of next generation kind of fintech infrastructure and software. And so have done a variety of things there as well, like things helping accelerate SMB credit lending and underwriting. As I talked to before, that was something that was incredibly broken at one of the big banks that I had worked at. And then they're also it's a little hard to talk through specific examples because a lot of the companies are still in stealth. The 2 that aren't in stealth, one is Keep Financial, which are the ex-founders of Kabbage, Rob and Catherine, their new company. And this is kind of fintech in the intersection of HR tech, right? Employers play a very large role in the financial lives of individuals, both as people who provide them salaries, but also provide them a tremendous amount of benefits. And so there's naturally a lot of connectivity between fintech and HR. In fact, a lot of consumer businesses have moved to kind of an employer-oriented channel partner type business. Keep, really great founders. Rob and Catherine have been together for a long time, started several companies together, most notable of which is Keep. And they have a really novel concept, which is they're basically a bonus management platform for large employers. Under the hood, that bonus is structured as a forgivable loan. What that means is you as a HR leader now have a new tool in your toolkit to issue signing and retention bonuses, and use Keep's platform to structure the whole program around it. How long does it vest over? How much is it? What are like the terms of forgiveness, et cetera, if you end up leaving?
You know, Rex, we're seeing a lot of fintech business models collapse under the current interest rate environment, who are only made possible because of the zero interest rates we saw over the last several years. So how are you evaluating fintech businesses in this new interest rate world we're living in? And what advice are you giving the founders thinking about starting businesses that are highly correlated to interest rates?
If your business is purely dependent on rates, it is probably not a good long-term business. And so you need to have other stuff. The vast majority of the companies I'm looking at are either kind of 80% gross margin software businesses. That's probably 70, 80% of the portfolio. And then a lot of them will make money off of financial services in some way, often payment processing, loan origination, that sort of stuff. The payment processing, not sensitive to rates. Generally, some of the loan stuff can be, because the loan markets themselves can expand or contract in terms of how much volume is going through the entire system, depending on where rates are. But they don't go away. It just might be twice as high one year, half as big the next year. So generally speaking, I don't invest in businesses that are, interest rates will make or break them. And like I said, for 70% plus of what I do, it literally has no impact. But some of them, it does have some impact. I think for a lot of the businesses I see, they basically are built such that they're very viable with interest rates being low. And then when interest rates go up, all of a sudden they have a new kind of unexpected revenue stream that's great and beneficial for them.
Got it. I mean, we are going to probably start talking about net interest margin more, going back to your Wall Street days. We are seeing firms like Coinbase generating some good interest margin for themselves. So who knows if that comes back into play for some of the startups. But I agree with you. If you're exposed to the interest rate environment and you don't have a 70, 80% SaaS business alongside of it, you're probably not going to gain a lot of interest these days, right?
Yep, totally. And I will say, I do think rates coming back will be interesting in conjunction with the launch of a whole bunch of real-time payments, FedNow plus real-time payments, RTP from the clearinghouse. One thing that is interesting to me generally, and I don't know the extent to which this is a huge opportunity for net new companies so much as net better features to be built into existing players, but there's over $10 trillion of deposits sitting on consumers and corporations' balance sheets that basically earns no interest. And that's kind of, interest rates are now north of 3%. That's $300 billion in lost interest income for all of these individuals. Wealth world is skewed. Most of those deposits are sitting with wealthy individuals. The second biggest thing would be large corporates. There is no reason there shouldn't be tooling that allows money to move around more quickly to basically find and access higher rates. And I think that will pull some of the low cost deposits out of the banking ecosystem over time. But I've also been continually surprised by just how sticky deposits are and how ineffective they are at moving to access higher rates, because banks don't want them to be incredibly mobile, because that's how their businesses operate. And
yeah, I mean, it's the hardest thing ever to move bank accounts and get your money out of a stale old, bank and try to move it into a digital first bank. I've experienced that firsthand. But I agree with you. I mean, maybe the saving grace is that as all these baby boomers kind of shift off and they have to transfer that wealth to the next generation of sort of, 30s, 40s, 50s who are a little bit more interested in higher interest rate, yielding products and more innovative solutions, we may see some of that locked in deposits free up. As the next generation has that transferred to them. But speaking of real-time deposits, I want to make sure I get your take on this and this current FTX situation. How do you think the FTX situation will impact the overall crypto ecosystem and then overall just the general venture capital ecosystem from an LP's perspective? And how are you going about engaging with your LPs about potential investment opportunities that kind of touch on the either crypto, Web3, or just overall riskier investment class?
Yeah, so first of all, I'm not really focused on crypto at all. I would invest in stuff that's connective tissue. In terms of what's happened with FTX, I think it's better to talk about just crypto at a high level. And what crypto is a new technology, right? It solves the Byzantine generals problem. And, you can have now a distributed ledger where people can agree on value in kind of an open, interesting way. So that's like a fundamentally new technology. The most exciting, but also the most problematic part of that is that new technology comes with a built-in financial system. And so what has driven so much of the growth within crypto has been financial speculation. And what that means is it has obscured the fact or the extent to which the fundamental technology has interesting affordances to it, because it's just been subsumed by this whole kind of financial speculation phenomenon. And so now that FTX has happened, what that has basically done is it's rediscovered why banking crises happen. So back in the 1850s and 60s, we didn't actually have, we definitely didn't have interstate banking, but instead we had a whole bunch of local banks who issued their own currencies. FTX issued its own currency that were thinly capitalized. FTX was very thinly capitalized, engaged in self-dealing between themselves and other entities. FTX did that. And what happened was this happened because of free banking laws that were passed in like Minnesota and then kind of spread to a few other states around the country. What happened was that led to an explosion of innovation. You had a whole bunch more banks than there used to be, issuing their own currencies, doing these things. And then all these banks started failing. And financial crises everywhere and always are predicated, or the transmission mechanism is short-term debt. And banks are basically built on short-term debt in the form of depositors, but often overnight lending in between themselves and other parties at the commercial level, right? And so what happened is during the wildcat banking areas, all of these banks started shutting down. The regulators were like, this is no good. And that's when we basically got the national banking regulations. And now if you like can't issue your own currency as a bank and all that. The flip side of it is the national regulations, you then ended up with like JP Morgan, who was basically so wealthy, he was able to bail out the federal government in the 1890s. So regulators stepping in is both good because it can protect consumers, but bad in that it can entrench incumbents and allow for these kind of massive outcomes and not allow you to see other things. So to go back to like the FTX thing, we basically now have kind of burned out some of the extent to which, financial speculation is the driving force within the crypto ecosystem. And now we can revisit the extent to which technology and the new technological affordances of what's going on in crypto is interesting. And by the way, like what happened with FTX was a CeFi problem, you'll hear people say, which is basically a centralized intermediary sitting on top of the crypto world. It was not a DeFi problem, right? There are some decentralized protocols that have still operated fine and haven't had these issues. DeFi protocols have had their own issues around hacking or people losing keys or other things like that, but not this sort of kind of bank run type phenomenon. And so now we'll get to see the extent to which this technology is really interesting. What this means for me as an investor is I invest in a lot of infrastructure or connective tissue. Right now, it's just very hard to build a new kind of infrastructure or connective tissue because there's so much noise in the ecosystem that if you want to get kind of your first 3 customers, it's just harder to do that. So I'm not saying I will never do stuff in and around crypto, but now it's just a kind of hard time for me to basically invest in some of the infrastructure-oriented stuff.
Yeah, it's interesting. It took 172 years for us to have another, 1850 bank collapse. So maybe we didn't really learn everything, but I guess when you have offshore entities that are skirting regulation and also trying to be their own JP Morgan of the crypto market by going out and saving everything that fails, you will see these things happen. And I agree with you. I think it sheds some light on how when there's zero interest rates and people are starving for more risk and more greed, shitty businesses get funded, and that's never a good thing in the end. And now we're going back to sort of focusing on the real quality businesses and the real fundamentals, which is always good for entrepreneurs and for investors in the long run. So we needed this to kind of reset expectations and reset what kind of businesses should be funded rather than everything being funded just because it's got a name like crypto involved in it. So I appreciate you sharing that with us.
Yeah, I think the two permanent things that can be problematic for crypto have nothing to do with kind of the technology, so to speak. One of the biggest things of crypto is it was a sociological phenomenon in which it invited people to rethink the traditional ways in which things were done, and it was new and exciting. Now it's not new and exciting, right? It's kind of tarnished. And so if you're a young person looking to do interesting work in technology, is crypto still the place you're going to be looking? And I think for a lot of people, the answer is no. And if you listen to a lot of people who invest aggressively in crypto, especially my former colleagues, you'll hear them say one of the big reasons they're excited about it is there's so many smart people working on it. And so one of the things will be is will smart people continue to want to work on it, right? Because that's often, you kind of make the world you want to live in based on how much effort you put into it. And so if people stop because it's no longer attractive to them, even if the fundamental technology maybe could have been in some sense, that'll go away. So that sociological phenomenon, I think, is one big thing to track. And then the other big thing is the extent to which regulation just makes it so much harder and not necessarily in a good way, right? Like basically regulators didn't protect anyone from anything going on previously, and now they might just prevent other things. Regulation's hard, so I don't want to like be too negative on those. It's hard to get it right.
No, I agree with you. I think like looking at where human capital is spending their most valuable resource, which is time, is obviously a great indicator of what could become a reality. But I think human beings are also very fickle and psychologically easy to change when they see something catastrophic happen to where they were spending their time. And therefore, they could totally switch on a dime and then go spend time back on B2B SaaS or maybe FinTech based on something that happens like an FTX. So I agree on one hand, but I also think it could change very quickly, given how the blast radius of the FTX could be felt quite significantly, especially for people who are also being compensated through that ecosystem. So we'll leave it there. But, before we jump into our last section here, I want to ask, how would you describe the mission at Cambrian as a firm? And how are you trying to differentiate yourself as an emerging venture firm in this crowded venture market we have today?
So I recently had someone write a piece about me, and they called me a FinTech super connector, which is a little, I don't know, it sounds trite or something like that, but I think is a good general summary. So my goal is to provide incredibly networked capital, right? I've got 20 plus of the best founders involved as LPs in the fund. I have the whole Cambrian community and apparatus, and then I have my own extensive relationship that I built up over many, many years with other investors, other entrepreneurs, et cetera, and trying to provide that networked capital and being dollar for dollar kind of the most helpful investor on your cap table because of that connectivity that I bring. And so that's my goal and role. And I think you talk to my founders, hopefully they'll all agree with you.
I like that. More tangible. It's better than being the king of FinTech, How can founders get in touch with you?
Email is rex@cambrianhq.com. You can also go to the website, cambrianhq.com. And then I'm working on producing more content as well. So I have a YouTube channel. Also, the handle there is CambrianHQ as well. So you check that out. And then I'm easy to find on LinkedIn and Twitter since Rex Salisbury. There aren't any other of them that I know of.
It's a fantastic name, and I definitely agree. You're a great follow on Twitter and LinkedIn. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
Yeah, my favorite podcast probably is Capital Isn't. I'm a big fan of the Chicago School of Economics. The Chicago School of Economics also gets a lot of criticism for basically being responsible for all the failures of free markets that are like going on in the world today. And so the premise of the show, Capital Isn't, is both what is working and what isn't within the capitalist society that we live in. And it's hosted by Bethany Lane, who's a journalist, and then also Luigi Zingales, who is a professor at Chicago. And it's just a great way. They have really great guests with kind of contrarian opinions, but they always have productive, interesting conversations. And so I really enjoy listening to Capital Isn't, and that's probably one podcast that not too many other people in the tech world are maybe listening to that I think is worth tuning into quite frequently.
No, I've never heard of it, but it sounds quite intellectual. I'll have to check it out. Next is your favorite newsletter or blog.
Yeah, so I first of all, my favorite way of consuming news is an RSS aggregator. So I use Feedly, and I probably subscribe to 40 plus newsletters, blogs, company blogs, and feeds. So that's the main way I kind of source my information diet. Probably favorite overall newsletter is Matt Levine's Money Stuff. My one claim to fame, or perhaps greatest claim to fame, is that I was once cited in one footnote of one of his newsletters. So
that's huge.
So you can see if you can find it. I know. I should retire. I should retire now.
Oh man, I would print that out and frame it, put it right behind my wall.
Exactly.
That's amazing.
My overall favorite one. And then my favorite FinTech newsletter is actually, I need to find the title of it, but it's written by Reggie at Lithic. It's FinTech Law. I'll send you the link afterwards and you can cut it in because it basically tracks everything that's going on in regulation by very smart folks who follow this as part of their day job. And so instead of just like, here's the latest thing that got raised, it's like, here's the regulatory changes and what kind of impacts are going on. And that, like, you have to understand that if you're an investor. I don't think enough people pay attention to what's going on from a regulatory perspective, but it's hard because you need this kind of translation layer. I don't have the time to think about what that means. And so that's why I love following their work as well.
It's like straight from the source, but also a little bit of more digestible rather than just taking a soundbite from it, which is important. Next is your favorite tech gadget.
So favorite tech gadget has actually been discontinued. So Meta has the Facebook Portal, which is a dedicated video calling device. I bought my first one over 2 years ago. I have 2 small kids. It has fundamentally changed their relationship with their grandparents in that they can basically call my grandparents. It has a wide angle lens, and my mother will actually read to my kids over the portal, and it's great. And they just can like hang out there, and it's kind of like reading in real person. So especially for parents who like want to have their kids interact with their grandparents, it's been probably the best tech device that I've bought in a long time. Unfortunately, it's been discontinued, I think, because they basically want to have, I don't know, but like they probably don't know how to monetize it or serve ads. Like I only want it to do video, and I don't want any of their dumb games or anything else on it. I just want like that real human connection. But the problem is like, how do you monetize that? So maybe that's an interesting critique of the metaverse is like, how do you actually be all about relationships and real human connection, but also monetize them? And are those things compatible?
That's the first time that's been mentioned. I know that, even Alexa is being discontinued as well because of monetization and just sort of cost of managing the system. But my 16-month-old daughter is very aware of FaceTiming with grandparents as well. The one problem is one, a phone is small, so that's too close to their face. And from the grandparent side, they don't understand
it's so hard.
how to hold it away from their face as well. So you got 2 problems with both people on either side not knowing how to use the phone.
It is so frustrating. Every parent knows this. It is so frustrating to try and do video calls on a phone with a child under the age of honestly 12. But definitely under the age of 4.
Yeah, absolutely. All right. Next is your favorite new trend.
Favorite new trend, people moving back to the Bay Area. That's my favorite new trend. I actually do have some friends who are boomeranging now, which is great.
That's really great. Favorite book?
Favorite book, the one I've probably reread the most in my life is Ender's Game, which is great. And then in particular, if you're ever learning a new language, great thing to do is basically reread one of your favorite old books in that new language, because you actually still know what the plot is and you don't get totally confused and you can map it over. So I've reread Ender's Game in French as well as in English.
That's amazing. I've never heard that.
If you're curious what buggers are called in French, they're called dorifort, I believe is the term they use, which is very funny.
That's a good life hack. I got to tell that one to my wife. She's trying to pick up another language again. That's a great way because she reads a lot as well. So thanks for sharing that. And last but not least, your favorite life lesson.
I think my favorite life lesson is invest in relationships and networks matter. So first of all, invest in relationships. The most important relationships are those closest to you, your life partner, your children, your family. And then that also translates into, what matters in terms of professionally. If you invest in having great relationships and networks and are supportive of individuals, that generally comes back around.
Hey, coming from the FinTech networking king himself, Rex Salisbury, to discuss building a community-driven venture fund. Thanks for joining us, Rex.
Thanks so much for having me, Matt. Been super fun.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter @MattyBCohen or @Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,